Streamlining Regulatory Compliance, the Do's and Don'ts. Today's speakers will be Ivana Tomisic, Global Customer Success Lead, Cristia Obisipo, Business Development Executive from Philippines, and Ken Okolo, Business Development Executive, Nigeria. Ivana, the stage is yours. Please start your presentation with the full screen of the presentation. You can unmute yourself now.
Thank you. Does everyone see my screen now?
Yes.
Okay. Hello, everyone. I'm Ivana Tomisic. In Oradian, I act as a Global Customer Success Lead, which means I'm responsible for Oradian's community of customers worldwide. I also act as a security risk and compliance officer of the company, which means that I drive initiatives within Oradian and helping our customers worldwide in their compliance and risk concerns. With my presentation, I will try to give a brief overview of global compliance landscape, but in order to do that, I would like to start with defining the compliance function. There are many definitions that all of us can find while browsing the internet, checking the site of the regulating institutions, but the one that I choose for this presentation is the definition of Bank for International Settlement, BIS. It is the institution that, as its participants, has central banks across the world as their members, and they drive monetary and financial stability on various markets worldwide. And how BIS sees compliance is quite comprehensive. So the first is purpose. So what BIS says the purpose of compliance function is to assist the financial institution in managing its compliance risk. And compliance risk can be defined as the risk of legal and regulatory penalties, financial losses, losses due to reputation, as a failure to comply with any applicable laws, regulations, and best practices. I think from the definition itself, it is clearly visible that this is an important topic for every financial institution performing their business in regulated environment. What I want to talk next for a couple of minutes is what can we observe as the changes in the environment that compliance functions are operating in. Firstly, we can observe that, especially in the last decade, there are a lot of changes in regulatory requirements. So regulators are more and more often issuing new regulations that somebody needs to track, analyze, implement, monitor. The regulators are also really often updating their existing regulation, introducing new requirements or changing and strengthening the existing requirements. This is mostly due because the financial services industry is transforming, especially with the digitization that we can monitor in the last decade. And this also leads to a regulator need to respond to the environment, and this is why the regulations in basically every country across the world is changing more often than ever. But also we can observe that compliance functions are pressured with is the cost reduction. Financial services industry has quite transformed, especially in the last decade. We can also observe a trend of fintechs entering the financial services market, more competition, and the financial institutions are under pressure to offer more affordable services to their clients and to reduce their operating expenses. This is also something that tackles the compliance function as itself. They're also, in a way, trying to reduce their costs, and many of them are recognizing that the traditional manual processes that might have worked in the past no longer work, and a need to automate the compliance activities and responsibilities is identified. With this transformation that I've mentioned a few times already, compliance function role has also changed, and a new set of skills is necessary in individual or in a team that comprises the compliance office to be able to perform their duties. Traditionally, I would say that people with a legal background were mostly the ones who were responsible for taking over the compliance duties. However, with the new emerging business model, with the digitization and change in how clients are using financial services, this specific knowledge is no longer enough, and compliance officers are usually struggling to comprise a set of skills in their team or in the individual that can perform the duties necessary for a compliance officer. There are also some other factors that can be seen across market, and that is the enhanced supervision. As I previously mentioned, the regulations are changing, but the approach of the regulator in supervising and auditing compliance has also changed. And we can monitor across markets that the regulator is enhancing their frequency and scope of the audits, the regulatory audits. They're also investing in their internal supervision capacity, which means they are hiring more professionals to conduct the supervision of especially financial institutions. They are investing in tools and technology to help them to conduct the supervision more efficiently. And they are definitely training and educating their staff to be capable to conduct the supervision. What regulator has also done, most of the regulators have done in the past couple of years, they have increased fines and penalties for the failures of complying with regulatory requirements. Across the world, financial institutions are observing that their financial losses due to fine and penalties coming from the regulators have increased. This is also a strong change and a big pressure to compliance function in any financial institutions. If we look at other stakeholders, and that is definitely financial institution clients, they are becoming more aware of their consumer rights. They are becoming more financially literate. They are also tracking the changes on the market. They are aware that consumer protection laws are evolving and that their rights are increasing, and they are demanding for their rights while using especially financial services. I think that all of these aspects are showing that the environment where compliance operates is changed, and that the pressure on the compliance function has increased over a past decade. To show a bit more how compliance function has been changing over the last couple of years, I also want to show how the scope of responsibility and accountability of compliance function has changed over years. Obviously, there are a lot of differences from organization to organization in terms of what compliance office handles. But in the next couple of slides, I listed a few topics and regulations that are usually in the scope of responsibility of the compliance office. I already mentioned consumer protection laws. This is something compliance offices usually deal with. Data privacy laws, also a very important topic, becoming more important from year to year. We're living in an information age, in a digital age, and data privacy and protection of personal data is becoming more important in many countries across the world, and this is something that is often on the radar of compliance officers. I think that traditionally in financial services industry, anti-money laundering laws are in the scope of the compliance function, but also in the last couple of years, we are observing that the requirements are getting more strict, that the fines are getting bigger, and the compliance office is more pressured to spend more of their time to anti-money laundering laws compliance. There are also some internal things that many organizations have their internal, for example, whistleblowing policies, conflict of interest policies, and these are often part of the responsibility of the compliance office because of their neutral position in the organization. They're often responsible to monitor whistleblowing policies and conflict of interest policies and implement them at the end. Over years, reporting to regulatory bodies has also changed. It's more complex than ever. And although in many organizations, reporting is something that is being done across the organizations, or across the organization, often the compliance support is needed to track, to monitor, and to implement reporting requirements of a regulator. A few more topics to mention. Fraud management is sometimes seen being part of the compliance. So compliance office is often responsible for monitoring the fraud management processes and practices. Tax regulation as well. Compliance offices often need to track and analyze, and in the end, ensure implementation of changes in the tax regulations. And also a very important topic is business continuity, which is often part of something that compliance function deals with, especially with the increase in outsourcing services that financial institutions are using and managing the risk of third party, of risk of outsourcing. This is something that compliance needs to take care of. I will end here. I will not list any more, although I'm sure that in various countries and various institutions worldwide, there are even more topics that are covered by their compliance function. And I want to end this short overview with a proposal on how the transformation of the compliance function may be conducted to help respond to these pressuring, changing aspects that I was talking before. Firstly, what compliance function needs to focus on is adopting a risk-based approach and developing a risk-based framework. That means that instead of ticking a box of compliance issues that need to be resolved, it is better to focus on the risk exposure. Here, compliance function usually needs help across the organization to identify those risks. But what also compliance function needs is a clear set of roles and responsibilities to implement this framework. Because implementation of compliance requirements is usually divided across the organization, from the front office, middle office, to back office, to audit and risk. But how compliance function needs to position itself is as a center of excellence and provide the guidelines and the framework to the rest of the organization to implement compliance requirements successfully. What is also important is to focus on already mentioned roles and responsibilities and a clear reporting lines. So usually compliance office reports directly to the board, to the chief risk officer role, and this is a good position to be in. Besides that, it is also very, very important to ensure that across organization, the staff that needs to implement compliance requirements is well trained and educated on these requirements. Compliance function needs to involve a lot into providing training and education so that the staff that is responsible for implementing certain compliance requirements has a knowledge and can do it successfully. The next thing that is important is to set a process. From identifying new compliance requirements to evaluating their applicability to a certain organization, to the responsibility of implementation of compliance requirements, and in the end, monitoring and auditing. All of these steps of the process are equally important, and it is important that each step is covered by responsibility inside of the organization to be conducted efficiently. And lastly, but not less important, is definitely use the technology as much as possible. Technology today can make sure that a lot of compliance requirements are already inherently implemented into your processes. If you have a pre-built set of internal controls, if you have systems and tools that enable you to trace and keep accountability for all the activities that the staff conducts. The technologies also allow efficient reporting, data analytics to help monitor and audit implementation of compliance requirements. I would say that today it is responsibility of every compliance function to keep track of the changes, because technology in this area is evolving really quickly and rapidly, and utilizing these technologies can help compliance function to perform more effectively and more efficiently. With this, I would end my part, and thank you everyone for joining and listening. I would now invite my colleague Chai to continue with the topic of compliance in the Philippines.
Thank you very much, Ivana. Good morning and good afternoon to our audience. Let me just introduce myself. I am Chai Obispo, Business Development Executive for Philippines. And my role in Oradian is to assist financial institutions during the selection of their next core banking system. We've heard from the previous presentation that the function of compliance is very diverse and very broad. For the Philippine landscape, I will focus on the compliance to Anti-Money Laundering Act and Terrorist Financing Prevention and Suppression Act, and the key challenges of financial institutions that go around with it. In 2001, the government enacted the Republic Act number 9160, or Anti-Money Laundering Act of 2001, to protect and preserve the integrity and confidentiality of bank accounts and to ensure that the country shall not be used as a money laundering channel. A decade after that, the Terrorist Financing Prevention and Suppression Act was enacted to make the financing of terrorism a crime against the Filipino people and against the law of nations. The implementation of these acts have been very firm right from the start, but a much tighter compliance was imposed by Bangko Sentral following involvement of a Philippine bank in the Bangladesh cyber heist in 2016. Another event, which was just late last year, when BSP announced that it will be reviewing about 10 banks to assess their ties with an Australian bank caught in a massive money laundering scandal after its remittance partner failed to report about 20 million fund transfer transactions in and out of Australia to the Philippines and other parts of Southeast Asia. The transactions in question supposedly involve money for child exploitation. What makes this incident unique is that it involves very small amount of transactions which is not required to be reported to AMLA because the value of the transactions does not reach the reporting threshold, which is 500,000 or higher in a day as part of covered transactions. Next slide, please. This incident emphasized the need to strengthen suspicious transaction monitoring and reporting. To quote the BSP Deputy Governor for Financial Supervision, Ms. Chuchi Fonasher, she mentioned that banks and financial institutions cannot take for granted some transactions just because they involve small amounts. They should really do a close monitoring of activities of the transactions at the branch level. These two events leads to a string of challenges for financial institutions. The first challenge is on KYC and customer due diligence backlogs. To minimize penalties and reputational damage, the financial institutions are so keen to meet AMLA requirements. Yet many are overwhelmed by the very first steps of the process, finding themselves sitting on a huge KYC and due diligence backlogs. Why? First, because of the scale of the task. Collecting, validating, and continually updating the data for thousands of customers is time-consuming, and the frequently changing requirements of the regulator means that approaches to KYC needs to be re-engineered from time to time. Second, there are plenty of inefficiencies in the process which remains largely manual to this day. There is a gap on the solutions available in the market to optimize the review and approval process and to some extent allow the efficient use of third-party data, external providers, and artificial intelligence. Lastly, previously recorded information is buried in various paper or electronic files, proving hard to access, difficult to aggregate, and difficult to be audited both internally and by the regulatory body. The second string of challenges is stemming from the implementation of AMLA and TFPSA is the monitoring and detection of covered transactions and suspicious transactions. First, mainly due to lack of automation to monitor the amount and number of transactions on a customer level. Second is the need to aggregate the transaction amounts and frequency of transactions for clients with multiple accounts in one bank. Third is the capability of the bank system to generate reports which are accurate and complete for timely reporting to the regulatory body. What I just discussed are the common challenges in compliance in the Philippines. If you find yourselves relating to these challenges, rest assured that you are not alone and that solutions are available. With that, I will end my presentation and let me introduce Ken Okolo to provide a report for Nigeria.
Good morning, everyone, and welcome. My name is Ken Okolo. I lead the business development efforts for Radian in Nigeria. Prior to my joining Radian 2 years ago, I spent the last 7 to 8 years working with enterprise clients in Sub-Saharan Africa to select the right technology for their business. And so coming to the topic about compliance in Nigeria, my presentation this morning is skewed towards the current realities in Nigeria, which is really mobile and digital banking. And so in the next slide, I'll just spend a few minutes just giving a bit of history and background of the general regulatory framework in Nigeria. So in 1991, the federal government of Nigeria established the Bank and Other Financial Institutions Act, popularly known as the BOFIA Act. Since 1991, there's probably been about 5 other modifications. I think the earliest was in 2007. And really, this act just vests power with the Central Bank of Nigeria as the regulator for the industry as far as financial services is concerned. And so in a sense, we could say with the BOFIA Act and the Central Bank of Nigeria, it's almost like the CBN is the primary regulator. But aside that, secondary regulators, many from Nigeria in the audience here will know the Companies and Allied Matters Act. We also have the Nigerian Deposit Insurance Corporation Act, and this really established the NDIC as a corporation with the responsibility to ensure all deposit liabilities of licensed banks, as well as other deposit-taking financial institutions. And the focus here is to guarantee payments to depositors in the event of problems. Aside the NDIC Act has also been the foreign exchange. Again, focuses on monitoring and miscellaneous provisions. Again, that act was establishes an autonomous foreign exchange market and to provide for the monitoring and supervision of transactions in the foreign exchange market. So this regulatory framework, in a sense, set the foundation for the financial sector in Nigeria. However, there's been an issue. And the issue is that in the last couple of years, we've seen massive changes in the Nigerian financial landscape, for which really the regulation of those years wasn't really prepared for. So with the advent of fintech startups, alternative payment channels, digital or challenger banks, as we may call them, as well as even the traditional banks quickly adapting to all of these new inventions and changes, it meant that the market has really been disrupted. And so in a sense, the regulators have had to evolve as the market changes. Now, just to give a typical example of a real challenge that this might have brought about, very recent, I think about 2 years ago, there was an 11 billion naira fraud involving fintech and OFI, that's other financial institution, and a big commercial bank. And this incident really highlighted the need for close supervision and monitoring in this space. But then the Central Bank of Nigeria has responded very well. They've responded with circulars, they've responded with drafts, they've responded with new initiatives to be able to combat any possible risk from this changing financial landscape. And so we'll just look at a few of them in the next slide, a few things that have come on board. We've had the payment service banks, and then the Central Bank of Nigeria is really coming here with licensing and regulation for these PSBs, which are really focused on small businesses and low-income households. And the thing about the PSBs is that unlike deposit money banks and MFBs, payment service banks rely heavily on technology via digital financial services. So a lot of the services are really focused around mobile and digital channels. Something else that has cropped up over the years has been USSD, Unstructured Supplementary Service Data. Again, the Central Bank of Nigeria, I think there was a circular sometime in April 2018 that set out the regulations that governed this aspect of electronic payments. The goal again was to enhance security and to establish a common standard in the sector. Sometime in 2010, the central bank started to implement what the Uniform Bank Account Number is popularly known in Nigeria as NUBAN, largely successful with deposit money banks. And sometime in 2018, around about in November, the central bank released an exposure draft. And the objective here was to provide guidance for the extension of the scheme so that it's expanded to include other financial institutions, RFIs, due to the success that they had with the deposit money banks. And this draft really set out the implementation modality for NUBAN within OFIs. Obviously, with new technology, the changing landscape, security obviously is a big problem. There was the Cyber Crimes Prohibition and Prevention Act in 2015 as well, which really set issues around the strategy for ensuring security, what sort of risk management systems to put in place, and then monitoring and reporting as well to ensure security. Now, when we think of all of this, things that have been put in place by the regulators, it starts to really make us wonder whether these new technologies, doesn't it make regulatory compliance more difficult with this changing financial landscape? Well, personally, I don't think it makes compliance more difficult, and the Central Bank of Nigeria as well doesn't think so. And that's a quote from Aisha Ahmed, Deputy Governor of the Central Bank of Nigeria. I find the quote quite interesting, that digitization actually supports banking supervision as well as regulatory compliance. In the next slide, we'll just look at some possible regulatory scenarios and how technology has been able to aid compliance, especially when we look at, mobile and digital banks as a case study. A big challenge is customers are no longer coming into your branches. You don't have branches in the case of digital banks. How do you know your customer? And so a number of these new initiatives have relied heavily on artificial intelligence algorithms. Where do you live? Who's in your contact? What kind of SMS do you receive? Checking of BVN verifications. So all of this really has helped them, this kind of technology, to deal with that challenge of knowing your customer. Again, array of digital banks everywhere, loan outlets. Then there's the issue of a loan burden. I pick up a loan from here, I pick up another loan from here, I pick up another loan from here, and then ultimately makes it difficult to be able to pay back these loans. And so what these institutions have done, again, using technology, is integrations, integrate into the credit bureaus. More recently, there's a fintech provider, Okra, that's been able to even enable integrations with your banks to be able to retrieve your bank statements. All of this happening in the back end so that these financial institutions ultimately know who you are, what you've been doing, and what you could really accommodate in terms of loans. To reduce PAR, again, the institutions have devised technology to deal with this. Automated direct debits, money just coming out from your account when it's the due dates. Oftentimes during the loan application process, they've picked up your debit card details, and so they're able to do these debits automatically. And sometimes some have even gone a step further, where the required amount is not sitting in your account. They've gone as far as doing staggered deductions until the whole amount is collected. We hear that new technologies even being looked at the moment, where there's an aggregation of all the accounts that you have with the commercial banks or wherever they are, and so that they can even sweep funds from them if there's a need. I mean, that's probably still a long way to come. Another key challenge is non-existent regulations for new inventions. And that could be a problem because an institution sets out to come up with a really new invention, and then the regulator, slams back to say that, we want to provide fines or whatever, or comes up with completely new regulations that these institutions were not prepared for. And more recently, the regulators, using some of their agencies, have been working on providing sandboxes where new inventions can be tested, and that also keeps the regulator in the know as to what kind of technology is being propagated within the sector. In terms of money laundering, there's been a lot of anti-money laundering compliance software that using APIs could be able to integrate with your core banking application as well. Obviously, like we said before, another key challenge will be cybersecurity. And of course, with a really solid core banking application, issues around cybersecurity can also be adequately dealt with. So this is really just a brief of what, compliance at the moment really is like within the Nigerian landscape. Obviously, it's been very general. We've not gone into any specifics, just to give us an idea what truly is happening here and what could keep happening in the very near future as far as technology is concerned. So that's my presentation about the landscape in Nigeria. Thank you very much, everyone. Thanks for listening. Zoran?
Thank you very much, Ken. What three great presentations. Ivana provided us with a fantastic general overview, and then we have heard and seen examples about anti-money laundering from Philippines, and also from examples from Nigeria. It was very interesting for me to listen to all of this, because it looks like technology is definitely an enabler from both sides, from also for the people that would want to do some bad things, but also for banks that want to do the good things, because they're introducing a lot of transparency, and new technology is definitely helping about that and changing the landscape completely. But also it is noticeable that the governments and the regulators, actually, they're kind of chasing all the time what is going on the market, and they're enforcing the new regulations. And no matter how creative people can be in breaking the laws and things, government will always come back and enforce something new, and usually those laws are very strict, and they cover a lot of cases. Ivana, do you have something to add, or maybe Chai or Ken, before we go to Q&A?
Zoran, I think you made a good point, saying that it's basically a race between bad practices and regulators trying to enforce good practices and ensure, in a way, some kind of market stability, and which is even more important, the protection of the end clients and their rights.